All right. Hello. This is my options basic fundamental education session. This one is being recorded because, as you can see, I just have one person. This is a one-on-one session, and I think that this will be the most succinct and best way to record it and just give this out so people who can't make the group sessions whenever they are can look into this and get as much value from it as possible. What I am going to do is this is the kind of education right here where you don't really know what options are per se. Like, you know that there's calls and puts. You know that you buy a call if you want the stock to go up, and you know you buy a put if you want the stock to go down. But that's about all that you really know. This very short and sweet option basic fundamental session will teach you the the pure essence of what it is to buy a call, what it is to buy a put, what it is to sell a call, what it is to sell a put, how does it work, exactly what the risks are. So once we go over all of that, buying a call and buying a put, what does that mean? Selling a call and selling a put, what does that mean? We're going to culminate all of this with one option strategy called the wheel strategy. And if you had never heard of it, that's okay because you'll understand at the end, right? So sit back, relax, and enjoy. So, Andrew, let's get this party started. Okay. So, Andrew, um, I am sure that in your journey to learn stock options, you have heard many things. You have heard, oh, don't do options. They're risky. You'll lose all your money. Uh, you know, you got to be careful. All kinds of gloom and doom. Is that about accurate, Andrew?
Absolutely, 100% true.
Okay. Well, the truth is, Andrew, I'm gonna go ahead and preface this. The truth is that options can be less risky than buying shares. Options can be more fortuitous than buying shares. Options are very, very versatile. And once you understand them and you know what you're doing, then you can utilize them to your benefit. And when you know what you're doing, you will know exactly what the risks are. That's why options are great, because if you know what you're doing, you will know exactly what the risk is, right? So before we start, you must understand that the basic explanation of an option is that it is a derivative of an asset. The asset in this case being a stock. So it is called a derivative because it derives its worth, its value from the underlying stock. I'm sure that you've read um, uh, an option is controls 100 shares per contract of the underlying. When it says the underlying, it means the stock that that option belongs to. Another thing that you need to know is that an option um, an option contract is 100 shares of the underlying, right? And I'm going to uh, perhaps show an option chain here later. But what you need to know is that when I say a contract, an option contract, that's because that's how they are sold or bought. Every option contract has a few things. First and foremost, it has a strike price. So what is a strike price? Well, the strike price is the price at which the buyer and the seller agree are the price that either the seller will sell at or the buyer will buy at if you're talking about a call. And it's the inverse if you're talking about a put. Don't worry, we'll get into it if that sounds confusing. So they have a strike price, right? It has a expiration date, right? So now you know it has a strike price and an expiration date. And thirdly is, like I said, one contract will always be 100 shares of the underlying. It controls 100 shares of the underlying. But that can sound confusing. So all that really means is that you are buying the right, but not the obligation in a call to control 100 shares per contract of the underlying stock by a strike price. So before we get into the nitty gritty, right? I like to start off with an analogy, right? And so that way it sets the tone. It says, oh, okay, I get it now, right? Because I taught you that it's a contract, right? And before options, what is a contract? A contract is a piece of paper between two people that says something. Like you can write a contract to sell a car, or you can write a contract to your maid for doing work on what she'll do. Like a contract, basically in American English, at least, it's an agreement between two entities. Well, a contract for an option is just that. It's an agreement, a non-breakable agreement between the seller and the buyer. So now let me give you an example. So Andrew, pretend here I have Red Bull at my desk, right? Let's see if you can see. You see that Red Bull? I have Red Bull at my desk. So we're going to use Red Bull as an example. Okay, Andrew. So let's say you have 100 cans of brand new, never used Red Bull of whatever flavor you want, right? And those Red Bulls each at Walmart, for example, costs $10 a can. Okay? And you know that's what they cost. That's the market rate. That's the going rate. It's $10 a can, right? And then I think for whatever reason that Red Bull is going to go up in price next month. Before next month, at some point before next month, I believe that Red Bull is going to go from $10 to $15. Okay? That's what I believe. So then, Andrew, let's say we live in the same block, and I approach you and I go, "Hey Andrew, how you doing? So I noticed you got those 100 cans of Red Bull over there. So I'll tell you what. I know this is going to sound weird, but just, work with me. So what do you say? I give you $1 per can. So that's $100, Andrew, because you have 100 cans, right? And one contract represents 100 shares of the underlying. Okay. This contract represents the Red Bull. All right. So I say, Andrew, I'll give you $1. And for that dollar, and you get to keep that dollar no matter what happens. And I can't stress this enough, Andrew. This dollar I'm about to give you is yours to keep forever. Okay. But that dollar, makes, an unbreakable contract that we're going to do with each other. And you go, okay, well, what's that? I said, okay, I'll tell you. So I'll give you this dollar per can. So that's $100. And then you will give me the right, but not the obligation, which means I can do it if I want to. But if I don't want to, I don't have to do it. It's on me to decide. I will, you will give me the right, but not the obligation to buy your 100 cans of Red Bull for $10 a piece. Now, remember, they are worth $10 a piece right now, right now on the open market. So you say to me, you know, that's what they're worth right now. And I go, yeah, I know. But this agreement between you and me will expire in 30 days. So I have between now and 30 days from now at the latest to say, hey, Andrew, I want to buy the cans from you for $10. And you, none the wiser, you go, okay, sure, no problem. So you write the contract, and the contract says you are giving me the right, but not the obligation to buy Red Bull shares, or excuse me, Red Bull cans from you for $10 a piece. And for that right, you are charging me $1 per can, which is $100 per contract. So say, okay, great, boom. So now, fast forward, right? Now, Red Bull is worth $17 a can. It's crazy. You know, the Red Bull market just skyrocketed, right? For whatever reason. Okay. So on the 30th day, I come up to you and I said, hey, Andrew, I got this contract here. Remember, you have to um, sell me the cans for $10 because I have the right, but not the obligation. Well, I want to do it. I want to be the. I want to go ahead and do this, right? So you are forced, Andrew, to sell me your cans for $10 a piece because that was the strike price that I bought. Plus, you know, don't forget, Andrew, you received my $1 at the beginning. So in reality, you sold these cans to me for $11 a piece. Even though they're worth 17, you sold them to me for 11 because you sold them to me at 10 plus the $1 you received, which is 11. And what I did right there is I just gave a real world example of what a call option contract is. You were the seller, and what you did there is synonymous with selling a covered call, right? And I was the buyer. And what I did there was buying a call, just buying a call. So do you understand how that worked? Did you get it?
Yeah, I understand that.
Okay, straightforward, no questions.
Um, I guess I don't really have questions much about regular buying of calls and puts. They're pretty straightforward because I kind of understand that if it doesn't go to the strike price that you want to buy it at in the right side, depending on if it's a call or put, really the worst case scenario is you lose, premium.
Yeah, that
So
you pay.
that never worries me. It's the when you get into other examples later on when you're talking about selling calls and selling puts, that's where it seems like risk could be greater. That sometimes could be more confusing.
Yeah, we'll get there. Just try to so that this goes very smoothly. Just try to stick your questions to what we're talking about at the moment,
No problem. Yep,
or what we've talked about in the past. That is fine. Just try not to bring forward questions because I promise you we will get to it.
got it.
All right, cool. So now um I'm gonna go ahead and show my handy dandy and now we're gonna start to get it. Can you see my screen?
Yes,
All right. So I'll put my thing right here. Do you see my face on the screen as well?
yes.
All right, perfect. Okay, so now we're gonna get into definitions, okay, Andrew? So first, we're going to start with buying the call, and this is going to go pretty smoothly because it's pretty straightforward. I will stop occasionally and see if there's any questions, but I'm sure we're going to get through pretty quickly, right? But I promise you, you will get value out of this, so bear with me. All right. So what's the definition of buying a call, right? And notice I said not of a call, of buying a call, because Andrew, you have two kinds of options. You have calls and you have puts. And then you can do two things to both of those options. You can either be the buyer or you can be the seller. And then you can mix and match, right? But a call or a put can only be sold or can only be bought. That's it. So, first, we're going to talk about buying a call. So, when you buy a call, you have the right, but not the obligation, to buy 100 shares per contract of the underlying stock at the strike price by the expiration date. Okay. Again, you have the right, but not the obligation, to buy 100 shares per contract of the underlying stock at the strike price by the expiration date. Okay. You know what an expiration day is. That's self-explanatory. You know what a strike price is. And when I say you have the right, but not the obligation, this is what that means. In that early analogy that I gave you, remember that the example was that 30 days later, Red Bull went to $17. Remember I said that?
Yes.
Well, if I would have said um, 30 days later, Red Bull dropped down to $6 or $7 or $8 or even $9, it doesn't matter. It just went lower, right? Below the strike price of 10. Remember, your contract gives you the right, but not the obligation, to buy it at the strike price if you're the buyer. And if you're the buyer with a strike price at 10, but right before it expires, the actual underlying is only worth 9, are you going to exercise your right on that contract to buy it at 10 when you can buy it in the open market for 9? The answer is no, right? And that's why I say you have the right, but not the obligation. Now, if it's at 11 or 12 or 13 or 14 and you can buy it at 10, well, then yes, it behooves you to exercise it because you're getting it cheaper from the contract that you bought than you can on the open market. Does that make sense, Andrew?
Yes.
Okay. So now that you understand that, right? Now we're going to get into a really beautiful thing. We're going to get into a couple scenarios, right? And these scenarios are going to illustrate how it is actually sometimes less risky to buy options or calls in this case than buying shares. And then you're also going to find out how it can be more risky, but you're also going to find out how it can be more fortuitous, right? So we'll get into that. So we're going to have a couple scenarios. So here we go. So scenario one, XYZ stock is currently trading at exactly $10 a share. You buy a call for XYZ stock at a strike price of $10 that expires in 90 days. The call costs $1.50 a share. That means you have to pay the premium of $1.50 in order to buy the call. And that's $1.50 per share. So that's $150 per contract. Because remember, it controls 100 shares per contract. You bought one contract. So that means you paid $150. Now, person A, right? There's going to be two people. There's person A and person B. Person A, and they both have $1,000. They both have exactly $1,000. Person A buys shares with his $1,000. So he buys 100 shares of XYZ. Person B bought just one contract of XYZ and he paid $150. So now he has one contract worth $150 plus $850 in cash, right? So because they both start with $1,000. So now fast forward. In 90 days, XYZ stock rockets up to $17 a share. Okay. Person A, the person who bought shares, his portfolio is now worth $1,700. It's easy math. Because the stock went up $7, he bought 100 shares. It's now worth $1,700. Person B, however, he is worth $1,550. So before we move on to the next scenario, Andrew, can you tell me what things do you notice about the worth of person A and person B, and what they had to do in order to get that? Tell me what you notice.
Well, it looks like the difference between person A and persons B final outcome is person B had to pay a premium, so they had that $150 subtracted, looks like. And other than that, I would assume that person B had to exercise a contract to make the profits versus person A had bought the stock and just did nothing.
Well, I like the way that you're coming up with these. It wasn't 100% correct, so let me explain. What I was hoping you would say was like, wow, person A had to risk and have $1,000 in order to make $700. Person B only had to risk $150 in order to make $550 in this example. So the first thing I want you to notice is the cost of playing the game, right? So person A, if he wanted to buy shares and hold it for 90 days, he needed $1,000. You can't get 100 shares unless you have $1,000. Now, person B bought a call that expires in 90 days. And remember, when you buy a call, you are in control of the underlying. And the underlying is 100 shares per contract. So he got to control 100 shares of XYZ for 90 days for only $150 and with a strike price of 10. Meanwhile, person A had to buy the shares. Now, I do want to say, right, shares do not have an expiration date. Options do, right? So there's pros and cons to everything. But do you see how in this scenario, Andrew, person B was able to enter XYZ at a fairly de-risked way, because the most that he can lose if XYZ didn't go up, let's say it went down, is 150, because you can't lose more than the premium you pay for a call. So do you see how person B, although he made a $150 less than person A, he actually used $850 less than person A as well. Do you see that?
Yeah, I could tell you from firsthand experience, I've bought a stock before that went to zero and lost everything. So it would be much better to lose only $150 versus 1,000.
Right, right. Um, Now, so right now in this scenario, you learned that person B was able to use only 15% of his capital. And because it turned out fortuitous for him, where the stock went up, he went in with a low risk and came out with a high reward. Now, person A went balls to the wall, bought all shares, and it did go up. So he did make more money, but he also risked more than 4 times the amount that person B had to risk. So that's the first scenario. And the first scenario shows you how you can use options to enter a position with less capital risk, because you can only lose what you pay for. But we're going to go over other things. Do you understand it so far?
Yes.
Okay. And also, you said something I want to say, and I'm glad you said it. You said person B had to exercise. Um, he actually could not have exercised, right? So this is a cash value if he sold his contract right before it expired, and I'll tell you why. If he paid $150 of premium, right, and it goes to $17, and he only has 1,000, right? He only has 1,000. Remember, you need to exercise. You need $10 per share because the strike price is 10. So you need $1,000 in order to exercise if you want the shares, but you don't have to. You can sell the contract and get what's called its intrinsic value, which I will go over, and then call it a day. So in this example, person A sold on the same day that person B sold his option, and that money that they have, $1,700 and $1,550, is cash, just to keep it equal. Do you understand?
Let me repeat that to make sure I do understand, and tell me if I'm saying the wrong thing. So you're saying person B that bought the right to have this contract, instead of giving person A the money to get the shares, he could instead sell that contract if it's going in his favor to get money as another option.
Absolutely. So,
Okay.
and he's not selling it to person A. They're just two separate people. But whenever you buy an option contract, until it expires, and we're going to go over this, but until it expires, it has value, right? It might not be a lot, but it has value, or it might be a lot, depending on what the underlying stock price is. So you can sell shares and you can sell option contracts, right? You don't have to exercise them. That means when you exercise it, remember, you have the right but not the obligation to buy, in this case, 100 shares at a $10 strike price. You can also sell that contract, which has value, to whoever wants to buy it. And there's always buyers. I'm not going to get into why there's always buyers, but you don't have to exercise it. You can also sell it for what it's worth. Does that make sense?
It does.
Is there a but coming?
No, I
Okay.
understand it.
All right, cool. So we're clear. We can move on to the next thing.
Yep.
All right. All right. So here is scenario 2. In scenario 2, the same. So person A is the same in all of these scenarios. Person A buys shares, right? So in scenario 2, in 90 days, the stock falls to $5. Now, how much is each person worth? Well, person A is worth 500 because he bought shares and they fell by 50%. So now his portfolio is worth $500. Person B is worth $850. Can you tell me why person B is worth $850?
Because he only lost the premium he paid for the option to buy or do something with the contract, and he didn't do anything because he wasn't obligated to, so he chose not to.
Exactly. So exactly. And remember, he had 850 in cash left. So that's why he's worth $850. So the call that he bought expired worthless. That means it has no value because the expiration date came and it was below the strike price that he bought. Good job. So now we're gonna start rolling now. So scenario 3, a little bit of a difference here. This time, each person spends their entire $1,000. Remember, I told you they each have $1,000. Well, this time each person spends their entire $1,000. Person A, it doesn't change. He buys the shares, so he has 100 shares. Person B, because now he wants to spend his full $1,000, he is able to buy 6 contracts, which cost him $150 a contract. So he spent $900 and he has 6 contracts, because you can't buy partial contracts, right? You can't say, hey, give me a contract with like controlling only like 50 shares. You can't do that. One contract will always control 100 shares of the underlying, and that'll never change. Okay. So because that'll never change, he can only buy 6, and therefore he has $100 in cash left over. Are you with me so far?
Yep, I understand it.
So fast forward 90 days, XYZ stock rockets up to $17 a share. What is person A worth? Well, we know person A worth $1,700, just like it was in scenario 1. Person A, nothing changed. It's the same thing. He bought shares, and that's what the shares are worth. However, look at what person B is worth. Person B is worth $4,200 plus his $100 of cash that he had left over. So he's worth $4,300. Do you know why he's worth so much?
Because he owned multiple contracts.
Right, because he owns 6. So now I'm going to show you how to calculate that. You can always calculate at expiration. You can come up with a fictitious scenario and see how much your options will be worth at expiration if what you think is going to happen happens. So we know that he bought 6 contracts, right? So 6 of them, times $150 each, right? So he spent $900. Okay. Now, the strike price was 10. Okay, so that means he has a right but not the obligation to buy them for 10. They went to 17. So they went to 17, right? Which is $7 from 10. So because 17 minus 10 equals 7, right? So $7 is it's each option is worth $700, because 7 times 100 equals 7, because each share has a profit of $7 attached to it, and there's 100 shares per contract. So each contract is worth $700. He has 6 of them. So you multiply 700 times 6. That's $4,200. Plus the $100 of cash that he had, $4,300. So you see, the way to calculate how much your option will be worth, it's very, very simple. All you do is subtract the strike price from whatever price in your favor the option is. So let's say, let's use a weird number, $23. So if XYZ went to $23, right, a share, this is per share, we subtract the strike price, which is 10. So that'll equal 13. And now we multiply that times 100, because it has to represent 100 shares per contract. And that'll be 1,300. Each contract has an intrinsic value of $1,300. And then if you multiply that by 6, because we own 6 of them, that's $7,800. Do you understand how I got that?
Yes. One thing I'm not sure on, and maybe you're going to explain it in a second, is I know in the examples you showed that I had to pay a premium for the contract, and I would think that since I had to pay something out, that that would come into the calculation somewhere, and I'm not seeing that.
Right. It's a good question, but you're overcomplicated. Right. So the contract costs for you to get it in your hand 150. Now, I think a better way to answer your question is this. $4,200 is not my profit, right? And I think that is where I'll answer your question, because of this 4,200, what is my profit? Well, we spent 900, right? So 4,200 minus the 900 that we spend means that we are in the profit by 3,300. 4,200 is what it's worth, and 3,300 is my profit. Does that make
That makes sense. Yeah. Now I understand it. Thank you.
Yeah, no problem. Good question. I was going to go over it, but in a different way. So that's fine. People think differently. So this is okay. Right? So it's all about how you word it. I didn't say what is the profit. I said what is the worth of the portfolio. Your portfolio is worth the accumulated value of everything in it. The profit is you subtract what it's worth from what you started with, and then whatever's left over is your profit. So you got it?
Yes, I do.
All right. Next scenario. Okay, scenario number 4. This is the last one. We're going to go quick. Same as 3, except the stock this time goes down. So now, how much is person A worth? Well, person A is worth $500 because his shares fell by 50%, right? Person B is worth just $100 because all of the 6 contracts that he bought expired worthless, and all he has is $100 of cash left, right? So what's the moral of these 4 scenarios? Options have many uses. You learned that it can allow you to gain stake in a stock at a much less capital requirement, thus minimizing your risk. But you also learned that options can amplify your gains, like they did in the last scenario, right? While at the same time increasing your risk, which is like in this scenario, because he went balls to the wall and bought 6 contracts. And if it doesn't do what he wanted to do, remember, options have an expiration day. So therefore, he is going to, when it expires worthless, he's going to lose all of that money. And that is why people say you can lose everything. Yes, you can lose all of the premium that you pay if you hold till expiration and it expires worthless. That is completely true. But there's nuance to it. Sometimes you want to gamble. Sometimes you want to invest intelligently. It all depends on what you're doing. Like scenario 1 is for that intelligent investor who isn't sure if he wants to get into XYZ. So instead of buying shares and coming out of pocket $1,000 of capital, he says, let me buy a call. And that way, at least I have, I control the underlying. So if it goes up, I'll make money, but I don't have to put $1,000 into it. Or it can be like scenario 3, where you're really bullish on something and you buy as many contracts as you can, and then it does go your way. So you're going to make a whole bunch more money than if you just bought shares. But the risk is, like in scenario 4, if it goes down, you're going to lose all of that money, right? So are there any questions in anything I went over so far?
No.
Perfect. Let's move on. Okay, now we're going to get into understanding what it means to buy a put. And this is where people start to get confused, not on necessarily the what it represents, what buying a put represents, but it's the verbiage, right? So I'm going to walk you through this. So now we're gonna get onto the definition, right? So buying a put means you have the right, but not the obligation to sell 100 shares per contract of the underlying stock at the strike price by the expiration day. And then I say you buy a put when you think the stock will go down by or before the expiration day. Now, why do you think it's worded like that? The right but not the obligation to sell. When you buy a call, you have the right but not the obligation to buy. That makes sense, right?
Yeah.
Well, when you buy a put, you are also it is correct that you want the stock to go down. That's how you're going to make money. But the verbiage behind it is you have the right but not the obligation to sell. So let me put it into perspective. In the stock market, if you want to make money on something going down, not with options, what you have to do is you have to short something. Do you know how it works when you short something?
Never done it. No.
So okay, I'll explain it very quickly because a lot of people don't really understand this until they're like told. So when you go long something, it's very straightforward. You buy something at this price and you think it's going to increase in value. That's very straightforward, very easy to understand. But when you short something, that basically means that when you short shares, that means that you want it to go down. And the way in which it works in the army, in the stock market is like this. You have to borrow the shares from your broker, right? So let's pretend you're my broker. If I want to short XYZ, let's say XYZ is at 10 right now, and I think XYZ is going down to 5. So what I have to do is say, hey, broker, I need you to lend me when you do it with shares, you can do it however many shares you want. So you say to the broker, hey, broker, I need you to lend me 50 shares, 50 shares. And your broker will say, okay, I'll lend you these shares, but you have to pay me like a nickel a day that you're borrowing them. So whenever you return them, you just have to pay me a nickel a day. All right. Now, why am I borrowing them? Well, I'm borrowing them because as soon as you give them to me, remember, I think they're going to go down, but they're worth $10 right now. I'm going to borrow them from you and sell them to the open market instantly. So I borrowed them from you and sold them for 10. And then I think they're going to go down. So let's say they do go down. Let's say they go down to 5. Okay. Then actually let's say they go down to 6. So then what I am going to do is I'm going to buy them for 6, right? And return them to you because I borrowed them from you, pay you your 5 cents a day. And then I get to keep the difference from 10 to 6, which is $4. And that's how shorting works. When you short shares, you are borrowing shares from the broker, selling them at the market price, and then hoping that they go down so that you can buy them back, return them to the broker, and profit on the difference. Do you understand?
That is hard to conceptualize as just buying calls, really. It seems strange.
Right. Well, that's not puts yet. That's shorting, but there's a reason why I explained it that way. Do you understand how shorting works? Do you understand that concept?
Yeah, I think I understand it. Yeah.
Yeah, you borrow it, you sell it at whatever it's worth at that second, and then you hope that it drops because when it drops, you buy it from the market at its lower value, right? And then return it back to the broker because you have to return what you borrow, and then you get to keep the difference. Now, the way that you lose money is if you think it's going down and it actually goes up. So if I borrow it from you and it's worth $10, I sell it at 10. I think it's going to go down, but instead of going down, it goes up to 14. So that's what's called a short squeeze, by the way, right? These are how short squeezes happen. So I thought it was going to go down. It's going up instead. So what I have to do now, because I'm tired of losing money, is I have to buy it at 14, right? I have to buy it at 14 and then give it back and then give all those shares to the broker, leaving me with no shares, which means I just lost $4 per share, right? So you now know how a shorter makes money and how a shorter loses money. A shorter loses money if it goes up instead of down, and he has to buy the shares at a higher price than what he borrowed them at. Does that make sense?
Yeah.
Okay, so now we've come circle enough where I can explain buying a put. When you buy a put, you have the right but not the obligation to sell, right? So buying a put is kind of like like shorting, except when you short shares the way that I explained, you have the potential for unlimited loss because the stock can keep going up. And if you don't close out your short, right, then it can just keep on going up and you just can lose an unlimited amount of money if you short shares that way. However, if you bet on something going down by way of options, by way of buying a put, excuse me, well, then remember what I told you. You cannot lose more money than the premium that you pay. So when you buy a put, you have the right but not the obligation to sell at the strike price. Okay? So I'll give you two scenarios. You buy a put for XYZ. It's at $10 and you buy the $10 strike and you pay $1, right? So you paid $100 per contract. So that means XYZ stock has to go down more than $1 for you to make money, because if it only goes down $1, you break even. If it goes down $1, you don't make any money and you don't lose any money. If it goes down $1 and a penny, you make a penny, and so on and so forth. However, if it goes up unlimited amount, all that you lose is $100 because your put option will expire worthless to you, but you only paid 100 for it. So that's it. You only lose 100. So now the reason that it's worded, you have the right but not the obligation to sell, is because think about it. It makes sense if you think about it. If I buy a put for something, which means I want it to go down and the strike price is 10, that means I want the right but not the obligation to sell it at 10. Why would you want the right but not the obligation to sell it at 10? Because if it goes down to 6, you want to get paid for being right. If it goes down to 6, you want the right to sell it at $10, right? If you sell it at 10, because that's the strike price, then that means you profit the difference between 9 and 6. I say 9 because 9 was your break even. Do you understand so far what I mean by the right but not the obligation to sell?
Yeah, I understand that piece. As far as the math on the break even, I think I understand what you're saying there too, because it had to do with the premium you paid. So I think I follow it.
Right. It's very simple. I want you to write this down. Your break even, okay, when you buy a call, if you pay $1 and you buy a strike price of 10, that means you are saying that you need the stock to be above 10. Now, you need the stock to be above 11 to make money. And you need the stock to close at exactly 11 to break even, to not lose any money and not make any money. The reason for it is if you have the right but not the obligation to buy at 10, but you pay the guy at the beginning $1, well, then in order to make that dollar back, the stock has to go up at least $1 in value. So that way you break even. So that way you don't lose anything, but you don't make anything. Anything above 11 is profit. Does that make sense?
Yeah, we're that just applies to just the call, right? So that makes sense for calls. Yes.
Right. So now put, it's the same thing, but other way. If you want something to go down, now you have to say, okay, if I want something to go down at a strike price of 10 and I pay $1, well, then that means it has to go down at least $1 for me to break even. So the strike is 10. You subtract the $1 that you paid. So that means 9. So you needed to get to 9 to break even. Anything below $9, you make money if you're the buyer of the put. Does that make sense?
Yes.
Perfect. So you've learned how to calculate your break even, right? And you've learned how to calculate your profit. Anything past your break even is profit. Okay. So before we go into selling calls and selling puts, are there any questions on buying calls or buying puts? Anything at all? What they mean and how it works?
I think I understand in general what they mean and how it works. And if it's not appropriate to answer this question, we'll save it for later. What isn't clear to me is when you're talking about these premium things, is that something that's always fixed or is that negotiable?
The premium that you pay?
Yes.
Right. So that changes basically every single second. As the stock moves, it gets closer or farther away from the strike price that you want to buy or sell, right? So it fluctuates, and that's why I need to show you what an option chain looks like so that you can see it. As a matter of fact, I'll just do that for you right now. So let's just use a SPY option chain, right? And let's use something that for 3 May. Okay, I'm going to copy. I'm gonna go ahead and take a snip of it right now as we speak. Okay. 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 Can you see this?
Yeah.
So this is called a option chain. Okay. On the left of an option chain will always be calls. On the right of an option chain will always be puts. I use Thinkorswim, and right here it tells you it's 29 days away, right? And then you see all these other columns, which I won't get into except for extrinsic and intrinsic value, because before we get into selling calls and puts, I'm going to go ahead and talk about extrinsic and intrinsic value. So your question was the premium that you pay for an option, is that fixed, right? Well, you see here how SPY is at 51307 when it closed. That's where it was, 51307. You see that?
Yep.
So the blue, anything shaded in blue means all of these strike prices, and these are all the strike prices. So you'll see strike price 513, 512.50, 512, 511. It's going down. It's right here. It's from 513 and then it goes lower. It's probably a little bit confusing because in our mind, we like to say, okay, 513 and then down would be down. But no, on the option chain, it's the other way. Okay. By going in a physically up direction, it's showing you lower strikes, and then 0 is like all the way up here, right? So it's going from 513 to 0, right? And then it's going from 514 to infinity this way. The blue areas mean that the calls above, physically above the number, the actual value, are what's called in the money. On the put side, the blue, right, is above the number, and those are in the money. Now, it is in the money, right? For a call, let me explain what that means. So let's say you bought a 500 strike right here, a 500 strike call. And let's fast forward and let's pretend this was expiration day. Well, if the price is 513 and you own a 500 strike call, that means that you are in the money. Now it's a good time to segue to what intrinsic value is. Intrinsic value on expiration day, right? Or actually, excuse me, not on intrinsic value on every single day, right? Is the real dollar value between the strike and where the underlying value is actually at. So if it is right now, like right now, all right, and this is 29 days away. If I wanted to buy right now the 500 strike, okay, if we go to intrinsic value, it says 1321. It says 1321 because of after hours, right? If it was during a normal, if it was normal numbers, it would say 1307. Now the reason it would say 1307 is very easy. 500 is how many away from 51307? That's easy. It's $13.07 away from it. That is the intrinsic value. The word I want you to associate intrinsic value with in your mind is the actual value. Extrinsic value is known as time value. Time value actually goes down the more in the money it gets. A lot of people don't understand that. So for example, 500 has an intrinsic of, let's say that said 1307, it says 1321, but it has an extrinsic value of $5.91.5. If you were to buy the 499, the 499 would have an intrinsic value of 1421. This is what you pay, by the way, plus an extrinsic value of $5.73. Notice how it's like 17 cents less than the 500, but the intrinsic is a whole dollar. So you got $1 of intrinsic, or you paid for $1 of intrinsic value, right? But you got a discount in extrinsic value, right? So again, intrinsic value just means the actual value of the option of the option and the distance between the actual price of the underlying. Last thing I want you to write down on intrinsic value is only in the money options have intrinsic value. So for example, that's how options that you buy can expire completely worthless because they have no intrinsic value and there's no more time on them because remember, they expire. So pop quiz. If you bought a $10 strike call for XYZ and you paid $1, okay? And on expiration, XYZ stock is exactly $10.40. What is the intrinsic value of your option on expiration?
Well, it would be $10.48, but you actually wouldn't get any money because it would need to be over $11 to have
No,
intrinsic value, right?
no. So
Okay.
it would have to be at $11 to break even and over $11 to make you money. However, if you buy a call for XYZ stock and you pay $1 and then you fast forward and then on expiration day XYZ stock is $10.40. Isn't 10.40 higher than your strike price of 10? It is, right?
Yes.
Right. So you paid $1. So you're going to lose 60 cents, but you can sell that option right before it expires. You can sell it for 40 cents and make 40 cents back. And so you didn't make any money. You even lost a little bit, but you didn't lose everything because it had intrinsic value. XYZ stock is worth $10.40 on the market. So therefore, the intrinsic value of your call at a $10 strike is 40 cents. Does that make sense?
Yeah, it does. I understand that.
Perfect. Extrinsic value is time. When you're the buyer of an option, and this is a little bit of value that sellers get, when you're the buyer of an option, you are hoping that something happens. You're buying time, basically, right? So if XYZ stock is at $10 and I buy a call that expires in 90 days with a $14 strike, am I paying any intrinsic value on that call that I just bought? The answer is no, because it's out of the money. If I am buying the 10, if I am buying the 14 and the stock is at 10, that's $4 away from what the stock is worth. So I need the stock to move up all the way to $14 from $10 in order for this call that I'm buying to be worth anything. But it's still going to cost you money. What it's going to cost you is extrinsic value. So you're buying time. So if you buy 90 days, it's going to be more expensive than if you bought 30 days at the same strike price. Does that make sense?
Yeah.
Perfect. So now you've learned extrinsic value and intrinsic value, and you learned what a option chain looks like. In the middle, right, you have all of the strike prices, and the shaded area is in the money. Notice that they do like a crisscross thing, and that's because in the money at close for 513.07 was 513. So the 513 is in the money by 7 cents. The 513 call, that is. The 514 put, right? The 514 put is in the money by 93 cents, right? Remember, if I buy a 514 put, meaning I want it to go down, and it closes at 513.07, is it going the right way for me? The answer is yes. If I buy the 514, that means I want it to close below 514. So yes, 514 is in the money, but notice 513 is not in the money. That's because the price is 513.07. So until it reaches 512.99, this will be black, signifying out of the money. Black is out of the money. Blue is in the money. Does that make sense?
Yeah.
By the way, you'll get a copy of this recording to look over it again because, I don't expect you to remember it right away and you're probably not taking notes, but I'll also give you the handout that we're working on. Okay. So now that you know all of that, you learned extrinsic value, intrinsic value. You know what it means to buy a call. You know what it means to buy a put. You know why you buy a call and you know why you buy a put. And you know all the inherent risks that come with buying calls and that come with buying puts. Now we're going to get into a couple more things where I'm going to explain what it means to be naked and what it means to be covered. But before we learn that, you have to understand the definition of selling a call. So the definition of selling a call is the obligation to sell shares of the underlying stock at the strike price on or by the expiration date. Notice this is different than the definition of buying a call. Is you have the right but not the obligation. Well, that's because you're the buyer, right? But when you're the seller, you have the obligation. Can you imagine if you bought a call from some dude who didn't have the obligation to do right on the contract, if it went against him, it would be anarchy. No one would do options because yeah, they could be right, but the guy doesn't have to pay them. You know what I mean?
Yeah, I understand.
Okay, you must be busy, so I'll just keep talking.
No, I'm putting it on mute and off mute so that background noise doesn't jump in. I'm sorry.
No problem. Okay, so what does it mean to be the seller of a call? Well, that's really simple to understand. If you are the buyer of a call and I am the seller of a call, then just like in my Red Bull analogy, the seller of the call is the one who is giving the right but not the obligation to the other guy. Now, there's two ways to sell a call. You can sell a call covered, or you can sell a call naked. I'll just go ahead and tell you, you should never sell a naked call, or for that matter, a naked put. So just write that down in big bold. Never do it. Never, ever, ever. Because that gives unlimited risk. Plus, your broker probably won't let you do it anyway. But just never think that you should do it. Now, a covered call is called covered call because it is covered by the shares that you own. So if you own 100 shares of XYZ stock that you bought back in the day, then you can sell a covered call on them. And if the stock goes up more than you thought or wanted it to go up, because you don't want to lose your shares, but you will if you sell a covered call, you're not going to lose any money. You're only going to lose the potential for more gain on your shares because you have to sell them at a cheaper price than what they're worth for on the market, right? So let me explain. In the analogy I gave you with the Red Bull, remember I bought them for $4 back in the day, and I still have them, and now they're worth 10. If I sell a call to you because I own the Red Bull, it is a covered call. It is covered because I own the Red Bull. Now I sold it at a $10 strike, right? And you gave me $1. So that means that Red Bull has to go up to $11 or higher, or $11 for you to break even, and anything above $11 you make money. But what if it doesn't go to $11? If it doesn't go to $11, then you lose money. And that's what I want as the seller. I want you to lose money. But I'll give you two scenarios. If I sell you a covered call at $10 for this Red Bull, and Red Bull goes to 15, then you are going to give me $10 for my Red Bull plus the $1 that you gave me already. So it's like I sold my Red Bull for $11. Now you made money because you bought the right but not the obligation to buy them at $10, and now they're worth 14. So you made profit right away. As soon as you buy them from me, you can turn around and sell it to the open market at the going rate and make profit. Now, me as the seller and selling a covered call, the only thing that I lost was the potential profit, because if I didn't sell you the covered call, then I would be able to sell Red Bull today for $14. But I did sell you the covered call, and I was able to get $1 from you. So I got to guarantee me a $1 gain because it's like I sold them for 11. So a covered call simply means you are selling the right but not the obligation to someone else to buy your shares, or in this case Red Bull, from you for whatever the strike price is, and in this case was $10, and they're going to pay you for it. So you paid me $1. Now, scenario 2, if you pay me $1 for the right to buy Red Bull at 10, but Red Bull goes down, then that means the call that you bought is going to expire worthless to you. So that means that $1 you gave me, or $100 per contract, is mine to keep, and they're on expiration day, and there's no risk attached to it. But I do own the underlying shares, right? And if they are going down, then my portfolio is going down in value. But if I am just a long-term investor, and no matter what happens, I'm either okay with selling it at the price that I sell the covered call at, or I'm okay holding the underlying stock, as long as it takes, because I know it'll recover. So that was a quick explanation of what a covered call is. Do you have any questions on that?
I guess I want to make sure I understand the risk, because I've tried to look up basics of stock stuff before, and I've seen people say that selling a covered call has unlimited risk, but I had a hard time understanding why they would say that. I guess it must be assigned the risk to the actual stock you owned if it went to zero, because the call option doesn't really have that. It's
Right.
just the
You hit it. You hit it right on the head, Andrew.
okay.
So you need to you need to um apply. You have to compartmentalize the two. The shares that you own are your shares. The covered call that you sell is an option that you sell. They are not mutually exclusive. They are mutually exclusive, but not when you say about risk. And let me explain. When you sell it, you know inherently that if it goes above the strike price that you sold, you're going to have to sell the shares that you have at the strike price that you sold. And you are going to be happy with that price. Now, let's say the stock goes down. Remember, selling the option is one thing, and selling the shares are another thing. If you sell a covered call, then and the stock goes down, think about it. The covered call that you sold is actually going up in value, because you can buy it back for much cheaper. And I'm not trying to confuse you, so let me backpedal a little bit. The covered call that you sold, right, for $1, is it, you can buy that back for less than $1, right? If the stock goes down, then the covered call that you sold will be worthless to the person who bought it. And that is good for you. Now, that's the covered call that you sold. Now, on the case of the shares that you own, if they go down in value, right, then yes, your portfolio is losing value because your stock is going down in value. But let me ask you this. If you sold the covered call or not, and the stock is going down in value, wouldn't your portfolio be going down in value as well? Either way?
Yeah, it definitely does.
Right. So to say that a covered call has unlimited risk is a misnomer. It is incorrect, because it doesn't. As a matter of fact, you can simply buy back the covered call. If your stock is going down and for whatever reason you got bad news on it and you no longer like the stock anymore for whatever reason, you don't have to hold it just because you have the covered call. What you have to do is close the covered call first for a profit, right? You're not going to get 100% profit, because the only way you get 100% profit is on expiration day. But if it goes down a little bit and you want to sell your shares, all you got to do is sell your covered call, or excuse me, buy back your covered call for less money than you received. So that's a good thing. You made a profit there. And then now you can sell the shares because you don't want it to drop anymore. You can do that. That was slightly advanced. Usually don't talk about that, but it is what it is. But a covered call doesn't have unlimited risk. A covered call, just by it being called a covered call, lets you know that there is not unlimited risk. When we get into naked calls here in a second, you will truly understand why it's called a covered call and why there isn't unlimited risk. Do you understand so far?
I do. I have one question just kind of going through my head. If I'm using a stock or something that I would typically want to hold long term to sell a covered call on, and for whatever reason the contract looks like it's going to get executed, and I don't really want to sell my shares because I like them, is there a way to get them back, or do you just have to basically let them be sold and buy them back on the open market?
Well, yes, that's them. There is a way, but we're not going to go over it. But
Okay,
it is called rolling the trade.
got it.
When you are the seller of an option, whether it's a put or a call, and you don't want to take exercise of the option yet, you can roll the trade. But we're not going to go over that. That's it. That's a little bit more advanced. But yes, there is possible. Okay. So do you understand what a covered call is?
Yes.
Okay. Now, naked call. So pretend now you didn't own the underlying shares, right? You people will sell a naked call or a covered call when they say, hey, well, this has gone up enough, I think it's going to take a breather or even go down. So I'm going to sell a covered call on it, right? Make a little bit extra dollars. But there's also people who sell naked calls. Now, I told you should never do this, but let me explain it to you. A naked call is when you, without owning the underlying, sell a call on something. Remember, the definition of selling a call is the obligation, right? The obligation to sell shares of the underlying stock at the strike price on or by the expiration, right? So if I sell a naked call on XYZ for $10 strike and I receive $1, okay? What happens if XYZ goes to $15? Remember that example I gave you about shorting shares and a short squeeze and all of that? Remember that?
Yeah.
Well, that now is almost exactly what happens if you sell a naked call. So if I when you short something, you want it to go down so that you can get the difference. However, when you sell a naked call, you just you don't it doesn't need to go down for you to make money. It just can't go up. But if it does go up, let's say it keeps going up, now you've added unlimited risk. So if I sell a naked call at a $10 strike and it goes to $14, how many dollars per share have I lost?
I guess if you the strike was 10, you'd lost $4 per share. And
Right.
you have to go buy it on the open market at 14 and sell it for 10.
Right. So I received one, right? I received one, and then I had to buy it for $4 more. So four minus one is three. So I lost $3 per share, right? And that's if it went to 14. What it can go to, they're not covered. So I have unlimited loss potential because it can go to 15, it can go to 16, it can go to 20, et cetera, et cetera, et cetera. You get it?
Yep.
Right. So that is a naked call. The last little thing I'd like you that I tell people is look at it like the term covered and naked like this. All right. When you sell a covered call, pretend that you're wearing a jacket and you are covered by the jacket. The jacket signifies the ownership of the shares of the call that you are selling. Selling a naked call means that you are just that, naked. You do not own the underlying. And when you're naked, there's no protection. So you have unlimited loss. Does that make sense?
Yep.
Okay. So that is what it means to sell a covered call and a naked call. And you have the definition of selling a call. Are there any questions so far? We're almost done.
Nope.
Okay. So, selling covered calls, right? The pros are there is no downside risk to the covered call itself. That does not mean that there's no downside risk to the shares. Do not conflate the two. All right. There is no downside risk to the covered call that you sold. There is downside risk to the underlying shares, but that is not the option. Does that make sense?
I understand that now. Yeah.
Okay. Another pro is that it's a good way to add income to you by paying you to potentially sell your shares at a certain price. Some people like to look at selling covered calls as a way to get a dividend, right? You can sell a weekly call, you can sell a monthly call, whatever. It's just a way to make a little bit more money in a certain amount of time. But the downside risk that I don't think I talk about is that every time that you sell for premium, you're getting taxed at what's called short-term capital gains rate, right? If you're American, I'm only talking about Americans. This is only circumvented if you're doing it within a tax deferred account like an IRA, or like a Roth or a traditional IRA. If you're doing it within that, well, then you're lucky because your premium selling will not be taxed. Now, if you aren't in an IRA, right, then you will always get taxed at the short-term capital gains rate. So just understand that whatever you make will be just added to your income, and then you'll be taxed at the short-term capital gains rate. So there is taxes on it if you're not doing it in a tax deferred account. Okay, so the cons is you minimize the potential future gain to whatever the premium received for selling it was. Meaning, if I sell a XYZ stock covered call at $10 and I receive $1, if it goes above $11, then I'm selling it. It's like I sold it for 11, right? So I am minimizing the potential gain the second I sell a covered call, but I'm guaranteeing myself some kind of a gain, right? So it all depends on how you look at it and what you want to do. So if I sell a covered call for 10 and it goes to 20, I just lost out on $9 per share of gain. Does that make sense?
It does.
Okay. Now here's what we were talking about is it says like you can this is not a con. This is just something I talk about, but I won't go over. Is you know how you asked, is there a way not to get exercise? Well, yes, you can. When you own the shares, what was one of the first things I taught you? Shares do not have an expiration date, right?
Right.
So the great thing about selling options is that you can roll forever your covered call. Rolling a covered call will allow you not to get exercise, meaning your shares won't get taken from you. And then you also, if you do it right, you make a little bit more premium. But again, you should only do this on stocks that you love and want to own for longer. The only thing I will say about rolling, right, the main reason to do it is, let's say you've owned a stock in a non-taxable account for six for no, let's say 10 months, right? And your shares are about to be called away from you. Well, if they get called away from you, then that means you create a taxable event, so you're going to have to pay taxes on all the gains that you made. Or you can do the smart thing and roll them for at least 2 more months, So that way you've owned the stock for 1 year in total. And when you own the stock for 1 year in total, then if you get exercise, then you get to pay long-term capital gains rate, which is much less than short-term capital gains rate on your profits. So you get to make money that way too, or you get to save money, I should say. Does that make sense?
It does.
Right. So that's one of the little nuggets I was telling you about. Okay, now naked, um, buying naked means like you can technically buy naked calls. You can, and you can buy naked puts, but buying naked just means you can't exercise the option because you don't have enough cash in your account to exercise it. So that just means um you have to sell them right before they expire to get the cash value. Just like in that scenario where the guy buys six contracts and leaving him with $100. Remember? Well,
Yep.
that's an example of buying naked calls because he has no more cash. So he can't exercise the calls, right? He has the right but not the obligation to buy it at the strike price, right? Well, he can't exercise them because then he'd have to give the person that he bought the calls from $10 per share. And he doesn't have any more cash. But what he can do is he can sell it to the brokerage, to the market maker for its intrinsic value, right? And then you can get settled in cash, right? So that scenario is a good explanation of what buying a naked call is. It just means that you don't have the money to exercise it, right? Buying, you can technically say buying a covered call, and that just means you have the cash to exercise it if you want to own the shares. Okay. Selling naked calls means you don't own the underlying stock. So if it goes up, you have the potential for unlimited risk. Remember, naked calls is bad. Selling naked calls is bad. Buying naked calls is okay if you're very bullish, right? But selling naked calls is bad. Selling naked puts means you don't have the cash to secure the put that you sold if exercised. So I think next we're going over the oh no, I forgot to put in here the definition of selling a put. So the definition of selling a put, right, is the obligation to buy shares of the underlying, right? So if XYZ stock is at $10 a share right now, and I sell a $9 put, what I am saying is whoever buys this $9 put from me and pays me premium, I am letting you know that I will 100% buy shares of XYZ from you for $9. And I have the cash to do it. Now, doing that, selling a naked put means you don't have the cash to do it, and there's risk for loss. So this will segue us perfectly into the wheel strategy. So before we get into the wheel strategy, if I was to tell you, which I already gave it away, but I'll say it anyway. So like, let's say you like the S&P 500, right? Which is currently at $513.07. All right. But you want to own it, but you don't want to own it at 513. You want to own it at 500, right? So I'm going to bring up the option chain again, and this expires in 29 days. So right here, it says that the 500 SPY is paying about $3.35 of premium per share. So if you liked SPY and you didn't know about options, then the only thing that you knew how to do, because you knew you wanted it at 500, but because you don't want it at 513, is you would put in a limit order for 100 shares to tell your broker, hey, as soon as SPY gets down to 500, I want to buy 100 shares. You're aware of that, right?
Yep.
Well, if I told you that you can get paid to own stocks that you love at a cheaper price, well, now you would probably believe me, but until I told you all this, you probably wouldn't believe me. But yes, it's true. Just like it says right here, I can sell a 500 strike put for SPY and get paid $3.35, right? So that means that I have 500 times 100. I have $50,000 in my account. If I have $50,000 in my account, okay, I can sell a $500 strike put. For that, I will get paid $3.35 per share. 3.35 times 100 equals $335. I will get paid $3.35 or $335 to give someone else the right but not the obligation to sell me shares of SPY for $500, right? And that, what I just told you, is selling a cash secured put. It is secured because you have the cash in your account to do it. Does that make sense?
Yeah.
Right. So now the home stretch, right around 2 hours. I guess even with just one person, it takes about the same amount of time. There's a lot of information. We're going to talk about the wheel strategy. This is the one and only strategy that this basic fundamental little education session has in it, because now it's going to put everything together in a way that I think will really make it hit home, because you understand what it means to buy a call and a put, and you understand what it means to sell a call and a put. So now you can implement the wheel strategy to finally conceptualize all of that. So before I start, I do need to say that the wheel strategy is an income strategy, meaning people who do this do it for income, and they do it. The best way to do this, like I told you, is in a tax deferred account, because the premium that you make is not taxed, right? So you don't have to pay Uncle Sam on it. Now, typically people who do this have hundreds of thousands of dollars to do this very simple strategy. You can do it weekly, you can do it bi-weekly, you can do it monthly, you can do it at however long you want to do it. There's only one way to do it. It's called the wheel strategy, because first you sell puts, cash secured puts, and you wait until the stock goes under the strike price that you sold, and then you sell covered calls, but you sell them at the same strike price that you got exercised on the cash secured puts. Another thing you do, I think I go over, but just in case I don't, is when you start the wheel strategy, it's good to do it at the money, because at the money gives you the most premium. For example, let me show you again. At the money in this example is 513. So if you sold the 513 put that expires 29 days from now, you will get paid about $7 a share. So that's 700 a contract, right? So that's how the wheel strategy. It's usually, not always, depending on your strategy, but it's usually at the money, because you sell a put, you get exercise. You sell a covered call, you get exercise. Now you have cash again, and then you go right back to selling a put. Does that make sense?
Yeah, I think so. I have to calculate it myself to really absorb it, kind of run through it myself.
No, we'll go through it. So let me just read. So it's an income strategy. It should only be done on great companies that you never want to sell at a loss, or an ETF like the Triple Q or the SPY, right? Pros, it pays regular premium for you. And because this is an income strategy, that's why I say you withdraw that money immediately. And then you can do with that money whatever you want. But you never, as long as you stick to the rules that I'm about to tell you, and your account value when it's going your way should always be the same, around the same amount, because any premium you're making, you're withdrawing, right? Cons requires a lot of capital, can have long periods of time where no income is made, and it's most beneficial if done in a tax deferred account like an IRA, or if you're Canadian, a TSFA. And this strategy typically underperforms buy and hold of the same equity over a long period of time. So now we're going to go into an example, right? And what I'll even do is I will do this. I will put up a let me stop sharing real quick so I can put up an Excel sheet. Okay. All right. Okay, so I'm gonna use this when the time comes. I'm gonna minimize this for now. Okay, so here's an example of a wheel strategy within a IRA, right? Okay, rule of income strategy is you always withdraw the premium received. Okay, that's rule number one. Always withdraw the premium received. So the SPY in this example that I already did, so it doesn't match today's price, but it's fine. The SPY is currently at 523.07. Step one, you sell a put. That means you have the obligation to buy shares of the underlying stock at the strike price on or by the expiration date. Okay, you're going to use the cash secured put to get shares and covered calls to sell shares. Those are going to be your means of making money, making profit, making premium. Okay. Step one, sell at the money cash secured put at strike 524. Right. So the reason I did that is because it was currently at 523.07. Right. But remember, I'm selling a put. So I'm selling the 524. So I have $55,000 in cash. Okay. When I sold the put, I got $5.98 per share, or $598 per contract. Okay. So now in your account, you see that you have $55,598. You're going to withdraw the $598, leaving you with the $55,000 that you started with. Fast forward 30 days. SPY closes at $510 per share. That means that now, right now, you are going to, let's do this in Excel. Okay. So 55,000 is our starting cash. Okay. And then over here, I'm going to put our profit. Okay. So right now, we made 598. Okay. 598 is our profit. Withdraw that. All right. Starting cash. Okay. 55,000. Okay. You sold, and then over here, I'm going to put strike. Okay. So you sold the 524. So here we're going to put the 524 strike. Okay. So now fast forward 30 days, SPY closes at 510. So okay, so it closed at 510. Was it exercised? The answer is yes. Okay, so now we do the math. So what you do is, okay, you got exercise at 524. So 524 times 100 is going to cost you $52,400. Okay. So right here, we're going to go 52,400. Okay. So you were exercise. Yes, you were exercised. How much did it cost you? 52,400. So now in your account, you have 100 shares of SPY and about $2,600 in cash. Okay. So this
So
is
stop there. One thing I'm not following is looking at your example there.
mhm,
It says the strike price was 524 and you're selling a put.
mhm.
So it
I'm,
says
I'm
after
hold on.
it says, go ahead.
I'm selling a put, not buying a put. Okay,
Okay.
go ahead.
So you're selling a put at 524 and then it closed at 510. So I guess I might be getting confused with all the different things we talked about. If the price is 510 and you were selling the put at 524,
Think about it.
you
Think
would be
about it. Can
forced to buy the stock at the
at
strike price, but you're actually buying it where you're not getting it as good of a price as you could have.
you are I do me a favor. Do
Yeah.
you, can you tell me the definition of selling a put?
Selling a put means that you have the right to sell.
No,
No.
no. Buying
Okay.
gives you the right. Remember, selling is obligation. Try again.
Okay. So selling a put means that I have the obligation to sell 100 shares of a stock at the strike price.
No,
Nope.
selling a put means you have the obligation to buy.
To buy. Okay. To buy at the strike price. So if the strike price is 524 and in 30 days the stock price is 510, if I buy $524 shares when they're actually selling for 510, isn't that a loss of money for me? Or
Yes,
am I missing something?
your account will be temporarily worth less money, but you're going to understand as this goes forward, right? You're not your account is not always worth more than what you started with. It just remember one of the rules were I'll show you again, right? One of
Yeah,
the
drive this home because I'm mixing them up. There's
Yeah, people always do that. That's why I told you. That's why I tried to like really like put that instill that in you. When you are the seller of a call or a put, you have the obligation to do something. When you are the buyer of a call or a put, you have the right but not the obligation. The buyer has the right but not the obligation. The seller has the obligation. That's why they get paid. Can you imagine if you paid a seller, right? For the right but not the obligation to do something. But then since the seller did not have the obligation either, he said, "Ah, fuck you. I'm not going to. I'm not going to do this for you. I don't care. Thanks for your money." You understand why it's important that the obligation must be attached to the seller?
yeah, because you're receiving money. I get that now.
Okay. So um again, right here, I want you to read this. Read this aloud. Right here. Read this. Right here. Read it.
Should only be done on great companies you will never sell at a loss or ETFs like QQQ or SPY.
So the reason I say that is because when you do the wheel strategy, it is in perpetuity, never worrying about what kind of drama the market is going into. If the market is to go down, right, and you're doing it on the SPY, yeah, you might not be a once you get exercised and you have these shares now and they keep losing value every day, you might not be able to make covered call money because the rule for selling a covered call is you have to sell it at the strike price that you got exercised on. But what if SPY goes down a lot and now you get nothing for selling that covered call strike? Well, that means you just sit on your hands and you do nothing, because what will eventually happen? Eventually, it'll recover because it is the SPY. It is the QQQ. It is the NASDAQ 100. Be very careful when doing this on individual companies, because I can't tell you what to do it on. All I can try to do to help you is on a great company that you don't think will ever go to zero. You know what I mean?
Mm-hmm.
So don't do this strategy on shitty companies. Okay.
It makes sense.
Okay. This strategy is not for crappy company, only for good ones. Okay. So now, right? Where was I? Okay. So now right here. So now we have shares, right? So you understand that it cost us $52,400, but we have shares now, right? So this column means we have shares. Okay. So yes. All right. So yes, we cost 52,000, but we have shares. Okay. So now we're on step 2. Step 2 is sell a covered call at the strike that you sold the cash secured put. So at the time when I was doing this, a 524 strike, right? Because I sold the cash secured put at the 524 strike, it is no longer at the money. Remember, the SPY is 510. So it is no longer at the money. At the money is only for selling the put. That's the put rule. The call rule is you have to sell it at whatever strike you got exercised on, which was the 524 strike. Does that make sense?
It does. I don't quite understand why you have to do that, but it makes sense what you're saying.
I'll tell you why. I'm glad you asked me the question. Why do you have to do that? Well, you sold a put on something and you got exercised, right? And then it went from 524 all the way down to 510. So now if I sell a 510 call, right? One, I'm not going to receive $14 in premium. It's just not going to happen. The premium isn't going to offset the loss that you just took. So you have to sell the call at the strike that you got exercised on, because now you're waiting for the stock to recover and go at or above 524 for your shares to be called away from you. And now you'll have cash right back in your account. So let me do this, and then you tell me if you don't understand.
I think I understand just what you said there. So by having the higher strike price on the covered call means that I'm going to collect premium for a period of time before the stock's taken away again, versus the potential for a higher probability of losing the stock right away.
Well, yes, and also more importantly is it is not intelligent to sell a lower covered call strike than what you were exercised at, because that's like saying I bought SPY at 524 and then I sold it at 511. Well, you just lost money, dummy. No, that's why you sell the covered call at whatever you get extra at, because then you're saying this: I got paid $500 to own SPY at 524, and then I got paid $200 to sell SPY at 524. So you made money both ways, and eventually it will recover. But if you don't do that, you're saying I got paid $500 to own SPY at 524, and then I got paid $500 to sell SPY at 511. Okay, well, you just lost a lot more money than you made when you do it that way. Does that make sense?
Yep.
Right. So the rule for selling a covered call is it must be at the strike that you sold the cash secured put. Okay, so now for selling the 524 strike, we are going to receive, right? And so it's going to be 524. So covered call is going to be 524. The profit that we're going to get is $2. So I'm going to put here 200. Okay, so this is my profit, 598, 200. Now we're going to fast forward 30 days. The SPY recovered and went all the way up to 528. So the close price was 528. Were you exercised? Yes, because 528 is above 524. So now in your account, you have 52,400 again. So this one was minus. Sorry. That's minus, and then this is plus. So we start with 55,000 minus 52,400 because we sold the cash secured put. Now we have to own shares. Then we sold the 524 strike. It closed at 528 30 days later. So that means I was exercised. And right back in my account, I have 52,400 plus the 2,600 for a $55,000 total, right? So we're right back to square one. You see that? They're the same. However, yep. The only difference between square one and now is I am richer by $798. Right? And so that is the wheel strategy, right? And then so let me finish this off. Step 2 is you sell a covered call strike that you sold the cash secured put. Then we receive the 200, right? Fast forward 30 days, it recovers. Outcome: the shares get called away, and 52,400 is back in your account for a total of 55,000 in your account. And the income in these 2 months was $798. And then you do it again. Rinse and repeat. And that, my friend, is the wheel strategy. So that pretty much is the end of the course. Now we're going to just, do some, practical exercises, make sure you get it, and then we'll call it a day. So
before we move on from this wheel strategy, when you go to repeat this cycle, I assume that you don't keep using the same strike price for multiple cycles because the price of your underlying is going to be fluctuating. Do you pick a new price to sell those puts at when you go through the cycle again?
Yes. I answered that, but it's okay.
Yeah.
You right here, read that. Step 1.
Sell at the money cash secured put at the strike of. Okay, so each time you look at the options chain, what's at the money? I think I get it.
Exactly. Whatever is at the money at the time of you starting the wheel is the strike that you start at. The at the money is the rule for the put. The rule for selling the call is whatever the strike was that you sold the put. That has to be that. If you do not do that, you are on a slippery slope.
Got it.
Okay. So pop quiz, right? So let me stop sharing. Okay. So who has the right but not the obligation? Is it the buyer or the seller of a call or a put?
A buyer has rights but not the obligation.
What does that mean? You have the right but not the obligation. What does that mean?
That means that I could choose to go through with a purchase, or I could just let the contract go expired and just lose my premium.
Right. Exactly. You have the right to exercise the option that you bought if it behooves you, if it's profitable for you, or if it, at least like in that example I gave you where you didn't make money, you actually lost money, but you didn't lose 100%. Remember the 1040, the 40 cents?
I do.
Right. So that's intrinsic value, right? Which is my next question. What is intrinsic value?
So the intrinsic value was the difference between the strike price and the underlying price, I
But
believe.
no, you are correct.
Based on the time of the contract, because I think it fluctuated.
No.
No.
Intrinsic value is always the difference between the actual price and the strike price, but only if it's in the money. So my next question was going to be, does intrinsic value happen on in the money options or out of the money options? The answer is in the money options. Intrinsic value, for example, I'll give you an example. Let's say XYZ stock is at $10 a share. All right. And I, on expiration day, have a call with an $8 strike price. The intrinsic value of my call is $2 because I own an $8 strike price call for XYZ, and XYZ is at 10. So that means it's $2 in the money, which means the intrinsic value is $2. If I owned a $12 strike for XYZ on expiration day and XYZ was $10, then my call is out of the money and has no intrinsic value. Does that make sense?
Yep. And the direction depends on calls or puts. So I'm trying to collect it in my head, thinking about all the things we talked about.
Well, yeah, no, it's really simple. Just whatever makes sense. If you're the buyer of a call, right?
Yep.
If you're the buyer of a call and XYZ stock is at, let's say, $100 a share, that's the actual price.
Mm-hmm.
If you have a call on expiration day with a strike price of $45, does your call have intrinsic value? And if so, how much?
No, because the stock price is I think the call's at 45, the strike price is $45 and the stock price is $100. So that means that yes, that has intrinsic value because the stock price is much higher than what you agreed to pay. So you'd have to subtract. No, I'm trying to think of this. The break even would be
No,
strike price.
we're not talking about break even. It is a very
Okay.
simple question. What is the intrinsic value of a strike price of 45 that you bought a call at?
55 bucks.
Exactly. That's it. It's not a trick question.
Oh, so
$55.
intrinsic value doesn't use premiums.
Intrinsic value is actual value, right?
Okay.
If I have a $10 bill, how much is my $10 bill worth?
$10.
$10. Right.
Yep.
That's what intrinsic value is. It is the actual value. It cannot be stolen from you. Time value is extrinsic value. Both in the money and out of the money can have time value, but time value decays the closer you get to expiration. So if I own a $110 strike call on XYZ and XYZ is at $100 and my call still has 7 days left on it, I have two questions for you. I'll say this again. I have the $110 strike and the underlying is at 100 and this is a call. Does my call have any intrinsic value?
Intrinsic value would be the price of the stock minus the strike.
If it's in the money. Is
It's
110
not in
in
the
the
money
money?
since it's $10 out of the money, so there is no intrinsic value, but there is a
Boom.
difference. I get that.
You got it. You got it. All right. So now question number two. Is there's a week left? Is there any extrinsic value on this option that I own?
Yes, there is because the price could change.
Well, no, not because the price could change, because there is time left. So
Yeah.
there is time value. That means I can sell it back, right? I can close it out, and I will still get some money back because of the time value. Extrinsic value only goes away 100% at the set that when it expires. Okay. When there's no more time, there is no more extrinsic value. Does that make sense?
I understand that. Now, just to clarify for the intrinsic value, because these are terms that I don't read about and use in my daily lifestyle here, is intrinsic value has nothing to do with time, or what about?
Correct. Intrinsic value has nothing to do with time. Nothing.
God.
Only extrinsic value has to do with time. That's why you have both. You have intrinsic value and extrinsic value. Extrinsic is time value, intrinsic is actual value. If I have a $10 bill, my $10 bill is worth $10. That's the actual value. So if I have a $10 strike on XYZ and XYZ is at $20 right now, okay, forget about the extrinsic value. I don't care if there's a week left or a day left or whatever. We're talking about intrinsic value. If I bought a $10 call strike for XYZ and right now XYZ is trading at $20 a share, that means that I have $10 and extrinsic value because it's worth $20 on the open market, and the strike of the call that I own is $10. So that's $10 away from 20. Does that make sense?
I think I'm getting it now that we're it's taken me a few times going through it to absorb all the concepts, I'll be honest.
No, that's okay. Okay. So next question. Who has the obligation to buy or sell the underlying asset of an option at expiration date?
So sellers have an obligation because they receive money. I remember from
Correct. Correct. Okay. The seller does. The seller. Now, I'm not trying to trick you, but I want you to think about this. Okay. Does the seller of a put, or not does, what does the seller of a put have the obligation to do? They have the obligation to blank a stock.
they have to buy a stock at the strike price.
Correct. Seller of a put. So therefore, the seller of a call has the obligation to what?
They have to sell a stock at a strike price.
Perfect. You got it. Okay, so we went over calls, puts, the wheel strategy, intrinsic value. You know what an option chain looks like. Yeah. So that's it, man. That is we went a little bit over 2 hours, but it's okay. It's a lot of information, and I know that you are better off now than you were before. Are there any final questions to anything?
I guess just one general question about the wheel strategy. Why is the wheel strategy in general something that won't beat buy and hold on, say, SPY? I did not
Oh,
understand that.
no, great question. Great question. So think about it, right? When we sold a put and we got the shares, we then did what? We sold the covered call at 524, I believe it was, right?
Right. Yep.
And then in the scenario I gave, the SPY recovered to 528, which is $4 above 524. Okay.
Yep.
Now, yes, we received some cash to offset that difference, but the reality is that it could have recovered all the way to like 550, right? And if it went to 550, we would have lost the shares. We still would have been in profit, but now we would have to sell an at the money put at 550. Now, the reason that it doesn't outperform buy and hold is just for that. Buy and hold, whilst they don't get, spending money, right? Premium, buy and hold gets 100% of whatever the upside is until they sell. So if you buy it at 100 and it goes to 200, you just made 200 in profit. But from $100 to $200, if between 100 and 200 you were doing the wheel strategy, there may have been gaps of over recovering where you miss out on gains. Does that make sense?
Yeah, but I'm thinking about it from the perspective, if let's say I have, I don't know, 500 grand sitting in an account that I want to be able to pull some money out of. Is it better to just leave that 500 grand in SPY and take a little bit out of it as the stock sits without doing options in the long run? Or is it better to do an options wheel in the long run?
Okay, so now you're trying to put me in a corner here.
No, I'm just trying to understand how I'm thinking.
Right.
You
No.
know,
So listen. That is subjective. I can't tell you what's 100% better. All I can tell you is that typically over the long term, buy and hold outperforms the wheel strategy. But I also told you that the wheel strategy is an income strategy that you
yeah,
that you do inside a tax deferred account. When you do that inside of a tax deferred account, you're not paying taxes on the premium that you're getting. So that's good, right? And
yeah, yeah.
that's another reason why typically the buy and hold outperforms the wheel strategy, because if you don't do it in a tax deferred account, all the gains that you made in the wheel strategy are going to be taxed, which are going to take profit away, right? So
Mhm.
now you're battling over recovering of the asset that you were forced to buy back or sell whatever part of the wheel strategy we're on. But do you see where I'm going with this?
It's subjective, definitely. Yeah, that a lot of the stuff when you think about it, it really depends, I guess, on your goals and what's happening. So
Right. So again, it's just subjective. The wheel strategy is usually done by people who are typically a lot older. Typically, they just want to get some spending money for whatever reason, right? And they're happy with it, and that's the most I can tell you. People do it, and there's pros and cons to it. Nothing is 100%, best way. If that was the case, then everyone would be doing the same thing. But yeah,
yeah, money's not easy. I understand. Yeah.
right. But that was a good question. I hope you understand it better. Do you have any other questions?
No, I appreciate your time. Thank you.
Okay, hold on one second. Let me stop the recording. And for those of you who are watching this recorded version, that concludes. So thank you. I hope you learned a lot. And thank you, Andrew, for being the representative, I should say, of this class. I think you had great questions. So I'm very glad that I did it with you and you asked the questions that you asked. So thank you, Andrew.